All right, let's get started. Welcome, everyone. I was asked by Laura Starks to put together a panel for the AFA, and I thought that a few things were as timely as the sustainability of government debt. And graciously, I have a rockstar lineup here of people both from the policy world and academia. We'll start with Nellie Nang, who's Undersecretary of the Treasury for Domestic Finance, and then we'll have 4 academics that I'll introduce as they come on a little bit later. So Nellie, you have 15 minutes, and then we'll do 5 minutes Q&A. And for those in the audience, you're able to ask questions through the ASSA webpage, the discussion box, and I will try to keep track of that as we go along. I'm unable to unmute the people asking questions, but you are able to ask questions. For the panelists, you guys will be able to ask questions unmuted. Please go ahead, Nellie.
Okay. Thanks, Annette, for inviting me, and this is pretty exciting to be on this panel. It's a very timely topic. The comments today I make are mine and not necessarily Treasury staff or Department of Treasury. Standard disclaimer. Okay, so I'm going to share my screen. Oops. Okay. All right. So Annette asked me to speak on a couple of topics. Obviously, this title of this panel is Government Debt, What Levels Are Sustainable? I'm going to, let me move forward here. I'm going backwards. I'm going to speak, okay, sorry to take, I'm going to speak on 2 topics today under the title of fiscal sustainability. One is fiscal limits and how policymakers are thinking about fiscal limits in the current environment and what kind of risk assessments. And the second, a little different but very closely related, is Treasury debt management. So under fiscal limits, the main message is R minus G, negative, less than 0, clearly affords more fiscal space, but there are fiscal limits. R minus G, less than 0, can switch and become positive. In the US, population growth has slowed, and government healthcare expenses are expected to increase substantially as the population ages. And I think one of the messages here is the R minus G framework doesn't determine an optimal debt ratio, but clearly net interest expenses can accelerate and become significant with implications for growth and stability. And in that sense, these are the limits that have to enter into fiscal policy considerations. And then under Treasury debt management, this is not aggregate demand management, but it does have implications because it does affect interest rates that the Treasury pays. Treasury debt managers work under a policy of fund at lowest cost over time. I'll try to put a little nuance behind those words, and then address this one question that people ask pretty regularly: why not extend debt maturity even more in this environment of low long rates? Okay, so let me just start on the first topic, fiscal sustainability. I just want to start with a picture that everyone is probably familiar with. And this is from Blanchard, his AEA presidential lecture. This is the US nominal GDP growth, the red line, and the blue line, an adjusted interest rate, adjusted for maturity and taxes. And you can see that for the most part, since 1950, the red line is above the blue line, so R minus G is negative. But then you have this period in the 80s where that didn't hold. And currently this gap has opened up again. But this is a period where R minus G less than 0 was importantly insignificant negative. Now, I'm using this picture just to show dynamics of what R minus G can get you. If you use, and again, this is from Blanchard, if you assume a zero primary balance, starting in any year T, using the tax adjusted rate, the debt to GDP ratios can fall when R minus G is zero. So this is starting in 50, this is starting in say 65, this is starting in 70. In the 80s, when that gap was not negative, you could see the debt to GDP didn't fall as much, but then it did turn negative again in the 2000s. And it's on this basis that one can conclude this suggests that the fiscal costs of high debt of fiscal costs are not that high. The next slide, just to put this all in perspective before I get to the current assessment, is this is the share of federal debt held by the public, which is from the CBO July 2021 report, going back to 1940. The current level is, as of July, was roughly 100%. The previous peak was a little over 100 just after World War II or during World War II. Clearly, there's a lot of variation over time. It falls for many reasons with the primary surplus and R minus G, but it varies quite a bit. There's some cyclicality in the past. Over the next 10 years, which is the sort of the standard projection for CBO, they project it stays about flat, but then inches up. Now, here's this is the projection for the deficit by CBO that I just want to point out because it sort of highlights some of the distinctions between rates and the primary deficit. So the CBO primary deficit, whoops, sorry about this. CBO, the sustained, this is back to 70. This is a sustained primary deficit, the dark purple bars. The pink is the net interest expense. So you can see there's been a deficit over a fair amount of time. This is 2008 and then currently with the pandemic. And it's expected to widen over the next decade because of aging population and rising healthcare costs. At the same time, net interest accelerates, and that has to do with the increased public debt and rising rates. I would note that this projection does not include the two fiscal packages that the administration has been promoting this year, which was at the time the jobs plan and the families plan, and now is the infrastructure and Build Back Better. The infrastructure bill infrastructure bill has been passed, but I would note the spend out and the effect on the deficit is pretty negligible in 2022 and 23. In part, that was by design. There was a recognition of ARP had a fair amount of fiscal stimulus. You were adding an infrastructure bill on top of that at a time where the economy might be near full employment. That plus infrastructure is not easily increased immediately. So I just highlight one that's not included here. Here is a picture of the debt to GDP that is forecast for the next decade. And the CBO projection that I had just pointed out is this orange dotted line, goes up a little bit to 106. This blue dotted is the OMB projection. And for those of you who aren't that deep into US government agencies and policies, the OMB is the administration's budget office. CBO is a nonpartisan budget office. But the OMB, because it is the administration, will have included the administration's packages. So you'll see it kind of ends in the same place in 2031, but it has a little different path. And, and of course, the forecasts are a little different. It's got higher revenues and higher outlays over the period, but it ends in the same place. And they actually end up with the interest rate at about the same place and net interest very similar. So that is one piece. So the forecast with the budget, with the fiscal packages, is not for a large increase in the debt to GDP ratio. On the other hand, with a recovery, it also is not a decline, which may have been a factor, may have been at play in previous decades. I would just note also this little red dot is the estimate for GDP, debt to GDP at the end of this fiscal year, which was October. And it has come in lower than had been projected in either July or in August. So all else equal, and that came in lower because revenues were higher and GDP, nominal GDP was higher. So it sort of brought it down. All else equal, of course, that just means the projected debt to GDP will be lower. Okay, so all that is leading to sort of near-term risk considerations and thinking about how one can think about fiscal limits in this environment. So as I showed, there's a sustained deficit, which accelerates starting mid-decade. Population growth is slow, healthcare expenses are rising, population is aging. There is a projected R minus G less than 0 through 2031, but it shrinks over the next decade as real rates are rising and growth moderates. So it's pretty big right now. Nominal GDP growth is pretty high, expected to be pretty high in 2022. So how does one think about these risk considerations? So if R minus G is, it remains negative, but you assume it isn't, some will view this as a lost opportunity to increase G, to make investments to increase G, or to pursue other goals, such as to reduce climate change. I point out a paper by Maroda and Sergeyev in 2021, where in the US, R minus G has been negative 70% of the time since 1870, which is much more frequent, much more frequent than other advanced economies, where it's about 50% of the time. That could reflect the US role. And the R minus G on average is about -1. A different consideration, though, is that even for negative R minus G, there's clearly less fiscal space to respond to a future shock, and probably more so for a supply shock. If it's a demand shock, and there's a positive covariance between the interest rate and fiscal needs, you get a little additional support, but a supply shock, it doesn't really help. And then, of course, there is the greater probability of R minus G turning positive when fiscal costs have been higher and population growth is lower. That's a result that Neil Maroda has worked on. And these, of course, have implications for reducing either other government programs that might be improving productivity or private investment that might be boosting productivity. So that is a bit of the risk assessment. I want to turn to Treasury debt management, which, as I want to emphasize to start with, it's not aggregate demand management. Fiscal spending needs are given, but it does have some objectives that have implications for fiscal sustainability. So objectives, they generally define as funding at lowest cost over time, which has many concepts in there and is sort of try to see if I can provide a little bit more substance around that. So one aspect of that is regular and predictable issuance to support liquidity of Treasury securities. In some sense, there's an issuance premium. Annette might call that a convenience yield, okay? And also issuing across the curve to support market access in many interest rate environments. And that was shown to be pretty important during this pandemic. So taking sort of expanding to modeling maturity decisions, there's kind of two ways to think about it. Well, at least two ways to think about it. I just wrote down two. One is you could think about maybe you should be issuing short. I mean, short rates, to the extent the yield curve is usually positive slope, issuing short can reduce rates, and it provides liquidity services of short risk-free assets. And there might be this positive covariance of rates and funding needs that make it all even better. So this is sort of the Greenwood, Hansenstein model. There's another maturity discussion, which is issue across the curve to facilitate hedging and pricing at different maturities. And it recognizes that covariance may not always be positive if there's aggregate supply shocks. And one model I point out is one by Terry Belton and others, including Brian Sack, who are on the TBAC committee for Treasury. But there's others, including some economists at Treasury who've been working on this. Okay, so let me just point to what I think is sort of a interesting chart. And the heading is, issuance was able to meet the very large fiscal funding needs of the pandemic, something I think we take for granted. But the left side is Treasury bills. And you can see this big spike is Treasury bill issuance in the second quarter of 2020, second quarter calendar year. That is more than 2.5 trillion of bills issued in a quarter. That more than doubled bill issuance outstandings. And then this is coupon issuance, which is 2 through 30. And you can see this started building up, but not nearly as quickly, but now is currently at levels that were double what they had been. So there was a lot of money that needed to be raised to fund the fiscal needs of the US. And it was done with a huge amount of bills, coupons following on a regular, more predictable basis, and then paying off some of these. So what this did to the maturity structure of treasuries is this chart on the left is the weighted average maturity of debt outstanding, had been 70 months, fell, this is the effect of the bill issuance, and then has risen pretty quickly back up to a little bit above 70. Debt maturing has been the converse. You can just kind of see that over time, this has varied a bit, reflecting either needs for financing and different philosophies of maturities. But for now, you can see it's been rising over the last decade, fell because of the recession, and has now been rising again. And it's near its high, historical since 1980. So there's this common question of why not issue more long? 10-year rate, 30-year rate is low, term premiums are low and negative and expected to rise. I think expected to rise in some part because they're lower than they've ever been, and this is the way we forecast, but also there could be issues of growth or inflation risk premium. So the expected term premiums are expected to rise. Both CBO and OMB have 10-year rates expected to increase to 3.2% over the second half of the decade. But you could also argue that long rates would reduce the volatility of interest expenses and would definitely reduce rollover risk. Okay, and there are models, though, to evaluate the risk-return trade-off of adjusting maturities. So here, I just want to show two examples of very simple static debt issuance strategies. And I just show these two because I think the empirical data sort of illustrates it very simply. So this one is a strategy, an issuance strategy that issues only these particular securities. So if you only issue bills, The standard deviation of the debt service to GDP is on the high end, but the cost, the debt service to GDP, is low. And as you move to issuing only 2 years or only 3 years or 5, you can kind of see you get this reduction in risk and not much increase in debt service over a good part of this part of the yield curve. As you start to issue longer and longer, the reduction in risk is not very high, and you clearly get a rise in the cost. This is also a very simple issuance strategy, but it's more some portfolios, and this represents what in 2017 was roughly this black dot, the design. So you have a lot of issuance in the 7-year space, around this, but this is the portfolio. This is a interesting model. You can add liquidity premium, you can add changing term premiums. There's lots of features you can add. But it's just sort of a issuance model that lets you make some adjustments along, it's a way to calculate. Okay. In addition, there's a lot of market outreach. In addition to just those calculations, there's a lot of market outreach. And I would say TBAC in May 2017 started exploring 50 to 100-year treasuries. And in August, they determined this demand for ultra longs would not be consistent enough for regular and predictable issuance, which is a significant factor to provide the convenience yield of treasury securities. And moreover, they would likely have to pay a significant premium for inflation risk. But they did begin to reviving the 20-year. And in November 19, they determined that there would be some regular demand for the 20-year from corporate pensions and insurance companies. And this is my last slide, Annette. In response to the pandemic, this is the change in the auction sizes across the yield curve to meet the needs. And this is February, and there was a big ramp up in 7 years. There was a introduction and therefore a large ramp up in 20 years, but 10, 2, 3, 5, 7, 10s all increase. But you can see these are like 90% increases, 50% increases. And the market was robust. It's sort of like it just absorbed it. And I think that's like a key consideration when we think about changing the debt structure, what should go into debt maturity decisions. Okay, summary, R minus G less than 0 does not imply there are no fiscal limits. There are some issues in the medium to long term needed to address the debt: low population growth, aging population, rising healthcare costs. But these drivers are more important for fiscal sustainability than the fiscal packages in the near term. The second point, debt maturities have been extended. They're near their top end. Some static simulations suggest there's limited reduction in volatility from extending further. And there's other considerations, market access, liquidity, that are really important to fund at lowest cost. So I'll stop there. Thank you very much.
Thank you very much, Nell. That was great. I love the graph with the mean standard deviation for the government debt maturity. I think that one's going to become a classic. Okay. We have a couple of questions, but in the interest of time, I'm going to move them to the Q&A session towards the end in order to move straight to Amar, please. And now if you could unshare, then Amar can share his slides.
Thanks.
All right, can you see my slides? Right, thank you very much, Annette, for inviting me to come. I figured I would use my 15 minutes to give a brief overview of our paper, A Goldilocks Theory of Fiscal Policy, joint work with Atif Mian and Ludwig Straub. This is a conceptual paper. I'm so glad that Nelly set the stage so excellently. We're interested in this paper and some of the main questions that this panel, of course, is interested in. We're living in a world where governments have very high debt burdens and very high deficits. And I think a lot of us, maybe 20 years ago, didn't think this would be possible. And so one question is, how can it be possible that the governments can sustain such large debt burdens? We want to also investigate a free lunch policy, a policy where a government may raise the deficit today and never have to cut deficits in the future. And we also want to explore whether fiscal policy is different at the zero lower bound. I only have 15 minutes. Let me give you the big overview. The four main results that I want to emphasize today are: first, R less than G is really not the right condition for thinking about whether a free lunch is possible. In fact, it ends up being R is less than G minus phi, where phi is the semi-elasticity of R minus G with respect to debt, government debt. We also have a result that the standard logic that an increase in fiscal deficits boosts the government debt to GDP ratio can actually flip at the zero lower bound. And you may run into a situation in which actually reducing deficits will actually lead to higher debt to GDP. The third thing is to explicitly consider income inequality. I think it's important because a lot of the correlations we've seen over time, there has been a rise in income inequality at the same time as it looks like fiscal space has expanded, and we're going to explore that. And finally, the model is tractable enough that we can actually take it to the data and calibrate where different economies are in the fiscal debt deficit diagram, and we're going to do that for the US and Japan. So in 15 minutes, I don't have a lot of time. I'm going to show you the basic framework and then some pictures. Please see the paper on our websites if you want more details. So the framework is going to have a household sector with two types of households: savers and spenders. Savers are going to have a pretty standard maximization problem with one important exception. Motivated by the great work of Annette, we're going to basically have direct utility over the government debt to GDP ratio, which is B in this equation. And so in addition to getting utility over consumption, households, the savers especially, are going to be having some utility directly over government debt to GDP. This thing is going to be increasing in concave, and that concavity plays a crucial role in the model. That is, as we saturate the market with government debt, the marginal utility is going to decline, and that's going to give an important force for why then the interest rate in steady state will be endogenous to the government debt that is in the economy. Spenders are going to be very simple. They're going to spend what they get. And when we talk about income inequality, we think of this mu parameter varying, whereas how much money is going to the savers versus the spenders. Okay, it's an endowment economy. Everything is certain. In the paper, we extend this. We actually add aggregate risk. We microfound the VB function with natural disasters. So that's something you can look at the paper to see more details there. The government's going to have a very simple fiscal policy. There's no capital in this model. There's no infrastructure investment. So all they do is spend and tax. They spend with the purpose of boosting aggregate demand. And in the baseline specification, the important thing, they obviously have to follow a government budget constraint, is going to be the primary deficit, which is Z. In the baseline model, we allow them to vary taxes and not spending, but you can easily switch that. Monetary policy here is going to be dominant in the sense that outside the zero lower bound region, monetary policy will implement the natural rate of interest that will clear the goods market. This is an important deviation from some of the other papers that have been written in this area that have, for example, the monetary authority potentially allowing for inflation when the fiscal policy expands. We don't have that here. Here, the monetary authority will react if they see inflation. They're only constrained by the zero lower bound. Simple downward nominal wage rigidity is going to make that zero lower bound bite, in the sense that if we're in the zero lower bound region in a steady state, output will fall below potential because employment will be weak and there's no way to get the kind of disinflation that you need to get the employment back up. Okay, so let me go through the pictures now. That's the basic framework. You can see the details in the paper. So what is fiscal space going to look like outside the zero lower bound part of this model? So right now, I'm just going to ignore the zero lower bound entirely. The way to think about it is to think of different steady states as a function of the government debt to GDP ratio, which is the key state variable in this model. So here I'm varying the government debt to GDP ratio, and I'm showing you nominal growth and nominal interest rates as a function of the government debt to GDP ratio for different steady states. Nominal growth is very easy here. It's just constant. There's nothing in the model without the ZLB that would lead it to change. And so it's always going to hit potential. So without the ZLB, there's no consideration in terms of having output go above or below potential output. The nominal interest rate, however, will show an interesting dynamic in that it will increase in the level of the government debt to GDP. This comes straight from the Sabers-Euler equation and the concavity of that VB. So as you saturate the market with more and more government debt, the household sector in equilibrium will require a higher nominal interest rate in order to be compensated for holding it. That, you can see, leads to a region in our model in which the nominal interest rate is below the nominal growth rate. And so that's in this region where government debt is relatively low. So now we can really get to the heart of what we're trying to do in this paper, and that is to evaluate fiscal space. So in this simple model, I'm about to move to talking about deficit policy in steady state. Okay, and what you're going to see is that in a steady state, the government will be able to run a permanent primary deficit. This kind of maps very well with Nellie's picture that she was showing prior to the COVID pandemic, where you see a permanent in steady state primary deficit. So what I'm going to do now to show that is to switch the vertical axis to the steady state deficit Z that exists for any given level of government debt to GDP. So what this curve is showing you is for a given level of government debt to GDP, what is the deficit in steady state that maintains government debt to GDP at a constant level? Okay. And you can see that this thing goes above zero wherever R is less than G, which is to say that whenever R is less than G, the government in a steady state can run a permanent primary fiscal deficit. Okay. And this debt deficit diagram is basically almost everything in this paper, right? So this is really where we're going to go for, and we're going to really explore this in more detail. And again, it's our way of conceptualizing fiscal space. That's what we mean when we have fiscal space. So for example, you could change the underlying parameters of the model and get this thing to come up and bigger, which would be a saying with some parameter changes, you have more fiscal space. So now we can answer a critical question, which is, when is there a free lunch? As Nellie was pointing out, this condition R is less than G is a very important condition. And a lot of the logic behind the R is less than G is that a free lunch policy is available whenever R is less than G, given the simple dynamic equation governing the government debt to GDP ratio, that if you have a one-time increase in the primary deficit, okay, or even a permanent increase, right, you don't ever have to cut deficits in the future if R is less than G, because it will trend towards a higher government debt to GDP ratio. But in the long run, you basically won't ever have to cut deficits because it will stable out at a higher level. Okay, so that's the logic that's been out there in the literature. The problem with that logic in our model is that R is endogenous to the debt level, okay, precisely because of this concavity of the VB function, that if you raise the deficit, you will raise the government debt to GDP ratio, which will endogenously then boost the interest rate on all the inframarginal debt. And so as a result, you cannot just have a free lunch anytime R is less than G. In fact, we make the point that R less than G is not really even that useful of an object in this model. It turns out that the useful object is R is less than G minus phi, where phi is the semi-elasticity of R minus G with respect to debt. We like this for two reasons. One, we think this insight is pretty robust theoretically. And second, there's a lot of empirical research actually trying to estimate precisely this phi. And so it's not so difficult to go country to country and try to emphasize exactly this. In our model, there's an exact correspondence between this semi-elasticity and the semi-elasticity of the convenience yield with respect to debt, which is exactly what Annette and Arvin estimated in their classic paper in the Journal of Political Economy. So this is really the condition that matters for whether a free lunch policy is possible. Let's see it graphically, okay? So let's go back to our deficit debt diagram. Let's do the phase diagram to show you what would happen if you ever go off steady state. So if you're, let's say here, and you decide to boost your deficit, what will happen, debt will trend upward, right? And you'll eventually have to adjust by either running a surplus to get back to steady state. Okay, so this makes it clear that a free lunch policy is not available for all of the steady states where R is less than G. In fact, that R is less than G minus phi corresponds exactly to the set of steady state where we have this blue part of the curve. Okay, in this region, there is a free lunch policy available. If you boost the deficit, you can achieve a new steady state with a higher government debt to GDP ratio without ever having to cut the deficit going forward. You can see there's a very important limit. Obviously, you can't do whatever you want. If you go all the way up here, you're not going to have a free lunch. You'll go transition this way. Eventually, you'll have to cut your deficit. But you can see, and the second thing is on these parts of the curve, there's clearly no free lunch policy possible, even though R is less than G. Okay, and the reason is that higher nominal interest rate on the inframarginal debt will lead to a situation where you've saturated the market, there's too much government debt, the nominal interest rate goes up, and now you can no longer afford to run the same deficit, you will have to cut your deficit. Without the ZLB, you start to see some of the comparative statics, and it really boils down to the importance of aggregate demand. So in this model, we can start to see what factors boost fiscal space. And if you use, for example, the trick that many macroeconomists use, which is to vary the discount rate as a proxy for aggregate demand, you can see that when the discount rate is very low, the savers are very patient, that obviously has a negative effect on the equilibrium nominal interest rate, and that therefore expands fiscal space. So we shouldn't be surprised that in recent years, over say the last 20 to 30 years, where we think aggregate demand has been relatively weak, there is a lot of fiscal space available for the government. Inequality in this model, given that the savers are really those financing the government debt, a rise in income inequality is very similar in that it will lower aggregate demand by shifting resources from people who spend every dollar to people who save, and that will therefore boost fiscal space. So again, it makes sense that in a world with more income inequality, savers have deeper pockets, they're willing to buy more government debt, you will have more fiscal space. So what changes with the zero lower bound? Now the critical graph, now again, we're looking at steady states. You see the big difference now is that the nominal growth rate will fall once we hit the zero lower bound, okay? The zero lower bound is hit when the government is running, not too much debt outstanding. There's kind of a demand, there's so much demand for government debt that the nominal interest rate hits the zero lower bound, and there you have a decline in the nominal growth rate. Okay, that's going to be the critical difference that's going to drive differences in fiscal space. So now what are we going to see in our fiscal space graph? Relative to what we had before, when we hit that zero lower bound, these are all again steady states, right? So these are steady states with a persistently shortfall in aggregate demand. You're going to see this curve kind of bend back, right? So what's going on? Well, now for the same level of government debt, you cannot run as large a deficit. Why? Because the nominal growth rate now is missing target. And so you're going to basically have a reduction in fiscal space coming from the standard effect that now the economy is not growing as much. And so you cannot run as aggressive a deficit policy. That's kind of the bad news of the zero lower bound. The good news of the zero lower bound is that we think a relatively robust result of the model is that a free lunch policy is always available to you if you're at the ZLB. If you find yourself at the ZLB, you can always boost your deficit without ever having to pay for it in the future. Again, there's a limit. You can't do it to infinity, but you can do it at least to some degree. We think this formalizes some of the intuition that's been out there in the MMT crowd, and you can see it very directly in this model. If the Phillips curve is steep enough in this model, that is, if shortfalls in aggregate demand lead to big declines in output, you can actually get this thing to bend backwards. What that means is here, if you actually boost your deficit, you actually will lower your government debt to GDP ratio. Okay, and the logic is very simple, right? Now, the aggregate demand shortfall is so painful that if you boost deficit, the effect on the nominal growth rate is large enough that you can actually reduce the government debt to GDP ratio. We're going to argue in our calibration that this is effectively where Japan was prior to the COVID pandemic. Two final things I want to say. First, on inequality. Now you can see that the effect of inequality actually flips if you're in the ZLB, right? So an increase in income inequality if you're at the ZLB cannot translate into a lower interest rate. Instead, it leads directly to a further shortfall in aggregate demand, which of course then limits your fiscal space because the nominal growth rate is lower. So you get this kind of interesting result that in normal times, higher income inequality boosts fiscal space, but in this time during the ZLB, it will actually lower fiscal space. The last thing I want to do is to show you the quantification. So really quantifying this or calibrating this model is really simple. You really just need an estimate of phi. The good news is there's a ton of research trying to estimate phi. And the estimates from the literature, there's basically 7-8 papers if you take both R minus G or the convenience yield specifications. The one we pick is 1.7%. So just to get the numbers in your head, that implies that if you have a 10 percentage point rise in the debt to GDP ratio, then you'll have a 17 basis point increase in the nominal interest rate or a 17 basis point decline in the convenience yield, if you'd like to put it that way. So we can calibrate the rest of the model. And then this is the final slide I'll show in that, and I'll hand it back over. Here's where we were in the United States and Japan on the eve of the COVID crisis. Many of people have asked us, well, do it for after the COVID crisis. The problem is, the COVID crisis, I mean, you know, the US 10-year treasury is what, fluctuated by 20 basis points in the last 2 weeks. So it's like very difficult to think about what the steady state is post-COVID. So let's go to 2019 where things were relatively stable. You can see that the calibration suggests that the maximum primary deficit that the US government could run was about 2% in a steady state equilibrium. That's the primary deficit. And Nellie's picture showed it well. That's about what it was, right? The government debt to GDP ratio we use includes state and local government debt, so it's a little bit different than the CBO figure. But here's where the US was. So our argument is as of 2019, there was maybe a little bit of a free lunch possible, but we were basically at where you could maximally run that deficit. Japan, on the other hand, we argue was on this backward part sloping, right? That they were in a situation in which had they cut deficits, they could have actually potentially lowered, if they had reduced deficits, they could have increased the government debt to GDP ratio, right? And so they were in this kind of more perverse situation in which actually the cut in any time you reduce the deficit or run a surplus, you're hurting aggregate demand so much that you're actually boosting the government debt to GDP ratio. So I'll conclude there on that, but thank you very much for your time.
Thank you very much, Ahmed. That was great. Let's move on to Stein, please.
Okay, can you hear me and see the slides? Great. Thank you so much, Annette, for inviting us. Excited to share some of the work that Zhengyang Zhang, Hanno Lustig, Mindy Shaolan, and myself have been working on for the last several years. And just want to kind of summarize our research agenda as taking an asset pricing perspective to this question of fiscal capacity that this panel deals with, right? And so I think the previous panelists have teed this up very nicely. You know, the great financial crisis and the COVID-19 pandemic have caused a major expansion in government debt, you know, due to counter-cyclical spending to boost aggregate demand, due to automatic stabilizers, and due to private sector rescue operations. Right, and like we've heard, government, you know, this expansion in deficits has taken place in a new macroeconomic environment, one with much lower interest rates than what we had kind of in the past. And so this has, you know, led to this question of, you know, is fiscal capacity potentially unlimited now that the risk-free interest rate is below the growth rate? Can the government just safely roll over its debt? Now, that argument, strictly speaking, is correct only in a deterministic model. And what we want to argue is that the growth that you know, enters in this R minus G is not deterministic growth, it's risky growth, it's stochastic growth, right? And so the asset pricing perspective, we think, is that, you know, the sources, that key source of macroeconomic risk, macroeconomic growth, is associated with a large price of risk, right? So asset pricing, stock market valuations are telling us that aggregate risk that aggregate growth is risky, and that it carries a large price of risk. And so we argue that the relevant condition here is not so much whether R is smaller than G, but whether R plus that risk premium for stochastic growth, for permanent growth shocks, is smaller or larger than G. Okay. So what we're going to do in our work is we're going to insist on pricing the entire government bond portfolio while respecting the asset pricing moments that we see in the data, including equities, because equities are going to be particularly valuable for learning about the price of permanent growth risk. And so what's going to come out of this analysis is that the risk-free interest rate, the risk-free term structure, is not the right discount rate function for valuing the entire government bond portfolio. So let me put some more meat on the bones. We're going to start from an equation that you're all familiar with, the government's budget constraint. We're going to iterate forward on that budget constraint and just impose one simple condition and no arbitrage condition on bonds of different maturities. That's going to result in an equation that equates the government debt, all the outstanding coupons of all the different bonds that the government has issued. That has to equal the expected present discounted value of future surpluses, where the key observation is that the stochastic discount factor is now going to have to price the risky assets in the economy, right? So in particular, this is not just an accounting identity. There's a restriction here. The restriction comes from the fact that the stochastic discount factor has to be pricing stocks and bonds correctly, right? And so that's what makes this a testable implication. Now then there's a last term, a terminal term, right? If we assume that this term goes to zero as time goes to infinity, which is a transversality condition, I'm going to come back to that later, then we're basically getting that the market value of government debt equals the expected risk-adjusted present discounted value of future primary surpluses. Now, this relationship holds ex ante, both in real and in nominal terms, and it actually also allows for sovereign default risk in something we show in an extension of our bond valuation puzzle paper. So what are the two key asset pricing insights we think as it pertains to this relationship? The first one is essentially that there's business cycle risk associated with these cash flows, right? And so for that, it's really important to take the perspective of an investor who participates in all government debt issuances and receives all the redemptions, right? So what is that investor? That investor that buys all government treasuries and receives all the coupons and all the principal repayments, that investor essentially has a claim to current and future primary surpluses. So just like we are used to thinking about stock valuations as a stock as being the present discounted value of future dividends, and just as we're used to thinking about these dividends as being pro-cyclical, here this investment strategy looks just like a stock in the sense that the cash flows on that strategy, the surpluses, are highly pro-cyclical. That's because tax revenues are pro-cyclical and government spending is counter-cyclical, as you can see in this graph, right? And so by standard asset pricing logic, the surplus pro-cyclicality means that this cash flow, this government bond portfolio, has the wrong way business cycle risk. It needs to earn a business cycle risk premium. The second insight from asset pricing has to do with the long run risk in the government bond portfolio. And here the key observation is that both government spending and tax revenues must be co-integrated with GDP. In any reasonable model that you can write down, the government spending to GDP ratio and the tax revenue to GDP ratio ultimately must be stationary objects. What that means right away is that the surplus claim is going to inherit whatever long run risk there is in the GDP claim, right? And so from asset pricing, we know that a claim to GDP is essentially an unlevered equity claim. And we know that there's a large equity risk premium. So there's also a large GDP risk premium. And that's because these permanent shocks to GDP are crucial and they carry a large price of risk. This is something we've learned from decades of research in asset pricing, right? And so what that tells us is that this claim to government spending and this claim to tax revenues must inherit that same long run risk premium from GDP, okay? Now that actually has implications for the transversality condition as well, because the tax, the transversality condition, thinks about the risk in taxes in the long run, right? As time goes to infinity, and so in the presence of a large long run GDP risk premium, this condition is going to be more likely to be satisfied, right? Because we'll be discounting these future taxes at a higher discount rate, reflecting that long run risk premium. So let's put these two asset pricing insights together to kind of speak to fiscal capacity, right? So as we've been discussing, the value of government debt is the present discounted value of future surpluses. You can break up this present value into two terms. The first term is basically the present value of future surpluses discounted at the risk neutral discount rate, right? At basically the treasury interest curve. The second term are these two covariance terms. These two covariance terms show up for the first time in the work of Bohn in 1995. Our contribution is to basically recognize that an investor who invests in all government debt essentially has a claim that is very risky, that is, has this pro-cyclical business cycle exposure, and to quantify these two covariance terms. And what we're going to argue is that in a realistic model of asset pricing that has the right amount of permanent risk as inferred from the stock market, these covariance terms are large. They dramatically reduce fiscal capacity, right? So these two covariance terms, combined are going to be large and negative. So if you think about fiscal capacity, given that surpluses in the US, primary surpluses in the US historically have been just about zero, this first term is just about zero, and the second term is large and negative, it suggests that the US has negative fiscal capacity, okay? Put more generally, whatever amount of future surpluses, if you wanted to support 100% debt to GDP, standard risk neutral logic would say you need to run 100% worth of surpluses in present value terms. Well, what that covariance term is going to do is going to knock that down a lot. You're going to need to be running a lot more surpluses to sustain the same amount of government debt once you take that aggregate risk into account. So that logic is going to pose a puzzle. Government bond portfolio is going to be more valuable, as we see in the data, there is a positive amount of government debt outstanding than the value of that surplus claim. Another way of expressing this puzzle is to put it in interest rate terms. The interest rate that the government is actually paying on its debt is much lower than the risk-adjusted interest rate on the surplus claim, where that risk-adjusted interest rate reflects both that business cycle risk premium and that long-run risk premium. So what we're going to do in our work is we're going to try to quantify the extent of that puzzle. And I don't have much time to refer you to the paper. Essentially, the exercise is going to proceed in 3 steps. We're first going to write down what we think is a realistic model for the cash flows for tax revenue and government spending. Then we're going to write down a stochastic discount factor that prices stocks and bonds. And then with those 2 ingredients in hand, we're going to be able to value a claim to future taxes and a claim to future spending. Right? And so at the end of the day, what we're going to find is that is the following picture, right? So what I'm showing you here is that is the debt to GDP ratio in the data. That's the dashed black line, as we just discussed, that's currently about 100% of GDP. And the right-hand side, which is the fiscal capacity, as measured by the present discounted risk-adjusted discounted value of future surpluses. And that's the blue line, right? And so what we want to point out is that, because of that, these negative covariance terms, that blue line is large and negative in absolute, it's negative. And so in absolute value, it's very large. It's about negative 129% of GDP on average. So the gap between the black line and the blue line is about 168% of GDP on average. That's the size of the bond valuation puzzle. Now, since the great financial crisis, this gap has widened dramatically all the way to about 400% of GDP in the last year of our sample in 2020. Okay, so let me give you a little bit more intuition for what's behind this result, right? So it's useful to just to fix ideas, to think about that fiscal capacity at some steady state level. Okay, and think of an unconditional average fiscal capacity. So debt to GDP is going to be the tax to GDP ratio times the valuation ratio for the tax claim, minus spending to GDP times the valuation ratio for the spending claim. And so these valuation ratios are going to be the key objects. And crucially, they're going to depend on the risk premium. So just for argument's sake, let's fix the risk premium to be constant. Okay. So now if a government, and this relates to what Amir was talking about, if a government wants to run permanent deficits, right? T is smaller than G unconditionally. And that government wants to have a positive debt capacity. The left-hand side is positive. That's only possible when the valuation ratio of the T claim is large and exceeds the valuation ratio of the G claim. And that's only possible when the risk premium on the tax claim is lower than the risk premium on the spending claim. And so basically what the government is doing in such a constellation is it is shifting the risk from bondholders onto the taxpayers by essentially making this tax claim a safe asset from the perspective of the government. Now, the taxpayer is short the tax claim. The taxpayer is paying the taxes. So from the perspective of the taxpayer, that is a very risky claim. So we are shifting the risk onto the taxpayer. Now, the problem with that, so there's basically a trade-off here, which is what we explore in our manufacturing risk-free debt paper, is a trade-off of shifting risk between taxpayers and bondholders. The problem with this constellation of risk premia is that it is inconsistent with this countercyclical fiscal policy that we actually see in the data, right? Which essentially is the risk premium on the tax claim is larger than the risk premium on the spending claim. Now, this argument, while quantitatively depends on R minus G, it kind of holds regardless of R minus G, right? Even if whether R minus G is positive or negative does not really change this argument. The key question is whether the risk premium on the T and the G claim, which of these two is larger. So, one question we've been receiving about our work is, to what extent are these results sensitive to the VER that we assume, or the stochastic discount factors, the market prices of risk in particular? What are standard errors on the surplus claim valuation? And so we've developed a new method in a recent update of our paper where we think about an upper bound for fiscal capacity. And we think this is an appealing concept because it's ultimately much easier to compute also for other countries, for example. And so basically what we're going to assume is we're going to bound the value of the tax claim and the value of the spending claim so that we can speak to what is the maximum fiscal capacity that a government could have. And so that now only depends on the risk premium on the GDP claim. So if we put in a couple of reasonable numbers, a risk premium on the GDP claim of 3%, that's going to give you a valuation ratio for the GDP claim of about 57. So what that's telling you is that if you run a steady state surplus of 0.05%, which is what the US has had for the last 74 years, then essentially the upper bound on your fiscal capacity is 3% of GDP, 57 times 0.05%. Put differently, if you want to generate 57% of GDP worth of debt, you need to run a permanent primary surplus of 1% of GDP. That's what that upper bound on fiscal capacity is telling us. Okay, so now we can calculate this upper bound dynamically, and interestingly, we can calculate standard errors around it. And so basically what we see is that, that upper bound on fiscal capacity, is positive between 1970 and 2000, but then turns basically to zero. Unconditionally, it's that 3% number I just quoted, which is this solid black line. Importantly, since the great financial crisis, when we've issued a ton of debt, and then again in response to COVID, the debt to GDP ratio has skyrocketed and is now kind of far away from that upper bound on fiscal capacity, right? So that's another way of stating the puzzle. We cannot accommodate the actual observed amount of government debt to GDP. It's kind of far above the upper bound on fiscal capacity. Okay, and we think this upper bound, again, like I said, it's kind of a almost model-free estimate of fiscal capacity. It's easy to compute, it's easy to extend to other countries, and it's conservative because of mean reversion assumptions that are underlying these calculations. I would like to refer you to the paper for those. So in my last couple of minutes, let me briefly talk about a few resolutions potentially of this bond valuation puzzle. And Marcus and Ricardo are going to tell us a lot more about this in the next few presentations. So let me be very short here. But violations of transversality are a first potential resolution. What we want to point out is that in models with realistic amounts of aggregate risk, those those explanations kind of have a hurdle to clear. Second, potential for future fiscal adjustment, and maybe something we have not seen since World War II, right? And so what we do in our papers, we calculate what does the probability of a permanent spending cut need to be to justify the observed debt to GDP ratio. And we calculate a 32% annual probability, which is obviously a very high number, which makes this peso explanation somewhat less plausible. And then we spend a lot of time in the paper on convenience yields. And I just want to point out kind of a tension here, which is that, yes, on the one hand, when US Treasuries carry convenience, there's a cash flow effect where, the more senior rich revenue from convenience we have, the larger our fiscal capacity becomes. But on the other hand, there is an offsetting effect here, a discount rate channel, which pushes in the opposite direction, which is that when you increase the convenience yield, you also raise the true risk-free rate, and you're going to raise the discount rate for T and G claims. And that discount rate effect is going to be lowering fiscal capacity. So, it ultimately depends on the relative strength of these cash flow and discount rate effects. But again, we think that makes convenience yields kind of not an obvious panacea to resolve this puzzle. So let me conclude here. We think a view of the treasury portfolio strategy that buys all outstanding treasuries, it kind of leads to this view that this is a risky investment, a risky asset, when sources of aggregate risk that are reflected in bond and stock prices are adequately quantified. There are a substantial risk premium on the government bond portfolio results. And that implies that the bond yields are puzzlingly low, especially recently. Now, there's a range of potential interpretations of this puzzle. One is that bond market investors fail to enforce the TVC. Marcus and Ricardo will tell us about this. Convenience yields may be much larger than we think. Our favorite explanations are that investors hold optimistic beliefs about future fiscal rectitude, which is something that we explore in another paper, and that future fiscal rectitude may be coming once debt levels are high enough, which is something I've pursued in work with Landvoigt and LNF and Schultz. If you're interested in looking at the latest version of our work, you can go to this website, publicdebtvaluation.com. I'll leave you with this cartoon. Where have all the bond market vigilantes gone? Thank you so much.
Thank you, last time. That was great. Let's go to Marcus to try to resolve the puzzle that's time. Go ahead, Marcus.
Thanks a lot, Annette, and thanks for setting the stage for all the previous speakers. So I will talk a little bit about my work with Sebastian Merkel and Yuli Sannikov, which tries to resolve some of these puzzles Stein and others have mentioned. First of all, I would like to say that, there's the big question is in how much government debt can the market absorb? And I would also argue there's a debt Laffer curve, and I will explain this debt Laffer curve in the debt sustainability analysis. And then I will also go into then, can the government run a Ponzi scheme? And I would argue that essentially the government runs a Ponzi scheme. And the argument would be why it can be. And just to give you a hint, the transversality condition in our model works and holds at the individual level, but not at the aggregate level. So if you do optimization when you solve a problem and put in a sequential problem, transversality condition holds at the individual level, but not at the repressive agent model level, because aggregation, there's some incomplete market frictions in the model. And this tries to evaluate the valuation puzzles, which Stein so nicely put bar, and in Japan and US. And I would argue that in Japan it's even much more dramatic than in the US. And so if you look at that to resolve this, you have to argue that US debt is a safe asset. Then you can resolve that. That's what we go after, and try to understand what a safe asset is in the first place and why you can resolve it with a safe asset. To make it a little bit more dramatic, in Japan, if you look at the primary surpluses, Stein was focusing and also Hans were focusing, that's essentially an asset pricing equation. The value, the real value, the nominal value of the government bonds divided by the price level. So the real value of all government debt is just the expected present value of primary surplus, discount with stochastic discount factor. And if you look at Japan in the past, the primary surplus in the last 60 years were always negative, except for some 5, 6, 7 years. And if you go in the future, they're always negative going forward. So any standard asset pricing model would say, oh, this has to be a negative value for the government debt, real value, or the price level has to shoot up through inflation. And the solution for that is to say there has to be some term, some bubble term we have ignored in this asset pricing equation. And of course, if you impose a transversality condition on the repressive agent in the economy, this bubble term is not appearing. And that's essentially also the equation you use for the fiscal theory of the price level. And that's one way to view this. How to rethink the fiscal theory of the price level and revive the fiscal theory of the price level for environment where R might be possibly below G. Now, if you look at this, let's suppose you have a primary surplus forever, which is negative. So always primary deficits all the time. And let's suppose it's just a fixed percentage of GDP. Then actually what you would get, the present value discounted at the, let's say, risk-free rate, because if it's risk-free, and I will introduce risk premium later on, then this would actually be a minus infinity number. Okay, and the bubble term has to be plus infinity in order to get something which you observe in the data sum. You see a positive number here. The real value of all government bonds in Japan is positive. In the US, it's positive. And let's suppose the surpluses are always negative going forward. So that's very hard to handle. And this is still the FTPL equation with this bubble term. And the question is, can we find a different discount rate such that we don't have a minus infinity term, which grows at the growth rate of the economy, let's say 3%, and is discounted at the real interest rate, let's say 1%. So that's minus infinity. And this is some bubble term, which is plus infinity. It's not easy to handle. So what can we use a different discount rate to really do that? So what we argue, there are many discount rates you can use as long as they're larger than G, and Ricardo will go into that as well. But we argue a particular discount rate you would like to use, we call this R bar, or double star. And that comes by looking at the situation from a different angle. Okay, so that's what I will argue, and then this bubble term will take a different form. So the bubble term will be some service flow component, and that's from the safe asset. Safe asset provides you some insurance, partial insurance for idiosyncratic risk, uninsurable idiosyncratic risk. And that's a new element in our model. So like in a Bewley model, like an AEAgoverment model, you have uninsurable idiosyncratic risk. And the government bond allows individuals to partially insure that. And that changes the whole equilibrium outcome. And that leads to this low interest rate because of precautionary savings. And then this term here, if one's a discounted a different or double star, it will be the case that this is not minus infinity. It will be a negative number, but not minus infinity. And the service flow, which is different from a convenience yield, and I will go into that, will be a positive finite number. So you have a negative finite number plus a positive finite number, then you have the real value of the government debt. And that's essentially what we argue. We would argue that, of course, this is an asset pricing equation. It has risk premium. All this has to be incorporated in that as well, like what Stein was pointing. But we say the action is really in the service flow. And that's why what resolves the puzzle. So let me go into this. What is the service flow? How can you think about that? Just to give you a little bit of more intuition. And I have a very stylized example here. Let's just consider two people, and instead of a continuum of people, an Alan and Beth, so A and B. And let's consider a very simple case. Let's suppose the primary surplus are 0 all the time. So it's the simplest case you can imagine. So in a standard asset pricing valuation, the real value of the government bonds would be 0. Okay, so the question is, can it be that you have the service flow makes it a positive value, the government bond? So here's Alan and Beth. They have positive cash flow assets. They have some productive assets, whatever they do. And they also hold this government bonds, which has no primary surplus at all. It never pays anything. So it's just a piece of paper. And what happens then the economy goes up, and then what happens that Alan will get a positive shock and Beth gets a negative shock. And if the world goes down, it's exactly the opposite. Okay. And a piece of paper is just a piece of paper. It just pays 0 cash flows. And then the world keeps on going up and down, and so forth. Now, what this piece of paper, this government bond allows them to do, they can actually say if the world goes up, then Alan can sell some of these cash flow assets in return to the government bond from Beth to Alan. And if the world goes down, they trade the other way around. So this way, they insure each other, even though markets are incomplete, they cannot directly trade contingent claims on it. But through this precautionary retrading of the assets, that's what we call what a safe asset is. You can easily retrade it depending on idiosyncratic shocks you face. And that's what this essentially Alan and Beth are doing. And this way, from an ex-ante perspective, they are both willing to hold a 0 cash flow asset because it allows them to partially complete the markets when the shocks play out, the idiosyncratic risk is playing out. So that's essentially what this asset does. Now, what we argue is that in times of crisis, in times of recessions, this idiosyncratic risk will be even higher. So in times of recessions, the service flow will be even more important, more valuable. And that makes the whole government bond a negative beta asset. Exactly the opposite what Stein, but Stein was a positive beta asset because, of course, the primary surpluses will be pro-cyclical, and that makes it a positive beta asset. But this bubbly service flow term goes in the opposite direction. And we show in the calibration that offsets more than the positive beta, and this negative beta is way more powerful. Moving the whole government bond makes it a negative beta asset. Okay, so that's, for this you need time-varying idiosyncratic risk. So the assumption here you need in times of crisis, idiosyncratic risk is going up. And that we think is a very reasonable assumption from going on there. So let me just go a little bit from how to view this. So rather than buying a bond and holding it, what you really have to look at is I buy a bond, and depending on what my idiosyncratic shock is, I buy and sell it and go further. So if I have a negative shock, I sell some of these bonds, I get cash flow in. If I have a positive shock, I buy more of the bonds, I get cash flow out from paying for the bond I'm buying. So I want to evaluate not the bond holding for sure, but I want to evaluate the cash flows from this trading strategy, from this dynamic trading strategy. And then from this, I get a different discount rate, or a different way to view this is the following. So if I have let's suppose we have all log utility, risk aversion is just 1. So typically the risk-free rate is just the time preference rate rho, how you discount your utility, plus expected growth rate of consumption in a continuous time setting. And that's the Ramsey term. And then you have minus the precautionary savings term, which is the variance of consumption. And the variance of consumption can have the aggregate growth risk of consumption. That's what Stein was focusing on. We have that too. But then there's also idiosyncratic risk. And because of this idiosyncratic risk, you want to save more in the government bond. You can retrade it later on. And that depresses, of course, the risk-free rate. Okay, and then there's an additional risk premium on the government bond. And then there might be some convenience yield on this stuff too, because the government bond is a good collateral, whatever you want to have it. You can have some convenience yield. And then if it's money, you might even have some additional term. Let me go move over there, sorry. You might have even this interest rate advantage because of a money term. Now, but what I really want to focus on, what we typically do, the risk-free rate you see in the marketplace is this risk-free rate, but the actual one, so it's depressed. It is depressed because of this idiosyncratic risk. I want to take out this idiosyncratic risk and move it over. I move it over to this part, and I call it service flow. And then the remaining part, I call my R double star. Okay, so I take out this idiosyncratic risk component and move it out because it comes from financial frictions. It comes from this retrading, and that gives me a different form. And actually this lowers the interest rate, not only of the government bond, but also of a very safe, let's say, corporate bond as well. So just looking at the convenience yield will not give it to you. So there's the argument always, this should be part of the convenience yield, but it's not the convenience yield component, it's something different. It's the safe asset component. And to some extent, if a corporate bond is very default free, it will also earn the safe asset. But the government has this ability to issue this safe assets in a different way and without having this Ponzi constraint. So they can run this Ponzi scheme, and that makes a difference. So the government can really run a Ponzi scheme, even though all individual agents' transversality conditions are satisfied. Okay, so that's essentially what's going on in our setting. So just to show you that the convenience yield itself is small, it doesn't do the trick. So if you do money utility function from convenience like this delta I, or like ARMA does bonding utility function, that's, you can do this. Ours is about this retrading, it's constant retrading, and that's similar to what also Ricardo will show. So what's going on is essentially, as idiosyncratic risk moves over time. So if in times of recessions, idiosyncratic risk will be high, in times of booms, idiosyncratic risk will be low, there's flight to safety. There will be flight to safety into the government bond. And of course, you get out of physical capital, so the stock market will tank. If idiosyncratic risk goes up, stock market will tank, but the government bond will rise because there's flight to safety automatically baked in this whole setting. So we set this up in a continuous time model. Everything is formal. I won't go into this formalism at all. But there's two main debt valuation paths, and that's a big contribution Stein and co-authors have done, is that one is the properties of the US primary surpluses. Roughly on average, they're zero. And they're pro-cyclical. So you would expect, they're high in booms and low in recessions. And the two puzzles are, the first puzzle is that essentially, the expected present value of the surpluses is negative, but in the real world, the real value of the government bonds is positive. How do you resolve that? And as I mentioned, in our setting, it's the service flow from this retrading. And it also says, what's a safe asset? A safe asset is one we can retrade with a low bid-ask spread, which means very information insensitive. That's, to other work by Gary Gordon and others. Why is the government bond a safe asset in this way? Now, the government debt risk premium puzzle is, of course, the cash flow, the primary surpluses, has a positive beta, but the service flow has a negative beta because in times of crisis, idiosyncratic risk goes up, and that makes the service flow component overturn the beta dimension in the whole thing. Now, let me show you the debt Laffer curve. And that's why, we think, it's not MMT, it's not, and that relates to Amar's work as well. We interpret this as a Laffer curve because it's very similar to a standard Laffer curve. And so what the government can do is can actually issue more bonds and dilute the value of the bonds through higher inflation. So it's like an inflation tax. So you can think of what the safe asset does. It allows people to partially insure themselves through retrading. And that's what we do. Your washing machine breaks down, you have a negative shock, you sell some of your government bonds to buy a new washing machine, your car breaks down, whatever. That's what you do. You can't write, you can write probably some insurance for a washing machine breaking down, but in general, it's limited. There's a lot of idiosyncratic risk you have to pay. And there's new research showing, 90% of the risk we bear is idiosyncratic risk. Now, that's why we want the government bond. And the question is, can the government tax this the insurance, the partial insurance we do through retrading? Yes, it can tax it by having higher inflation. Inflation is a tax on holding government bonds to reinsure yourself against this idiosyncratic risk. And what you can do is, the government can actually print more bonds, which is like a higher tax, a higher inflation tax on the precautionary savings they do, self-insurance through precautionary savings. And that's essentially doing that. And that leads to higher revenue for the government. So having a higher tax rate, higher inflation tax gives a higher revenue for the government, but it makes the bond less attractive. So you destroy the tax base. And that's a classic Laffer curve argument. You increase the tax rate, but you destroy the tax base. And that's why you get, if initially there's a huge rise on this, and then it goes down. You hit your peak, and then beyond the peak it goes down because you destroy the value of the government bonds. If you do it too much, you destroy the value of the government bonds. You can raise about 2% of GDP, but what's really important is this negative beta. So you get a lot of kick of this negative beta. If you don't have that, the outcome is way, way, way more tiny. Okay, so that's, and it's not driven by the convenience yield at all. It's not like some little seigniorage stuff from the convenience yield. It's really sizable, and it comes from the safe asset perspective. Now, of course, all of what I say is subject that you preserve the safe asset status, okay? So the bubble condition is like, the risk-free asset plus risk premium has to be smaller than G. The risk premium, because the safe asset status might be lost, or there might be some other default risk. All of that has to be put into this risk premium. And the bubbles might pop. So the safe asset is like a bubble. It can pop and also go away. So you have to preserve the safe asset status. That's often a relative statement. How well is US compared to Germany, compared to Japan, and things like that. The other thing is, as I mentioned before, you also have to preserve the ability to trade this asset very efficiently with a low bid-ask spread. That's what we saw in March 2020. The US Treasury 10-year was not trading well anymore because market making was breaking down. That killed off the safe asset role for the 10-year Treasury. And of course, the Fed stepped in as a market maker of last resort to really do the market making again, in addition to buying a lot of this stuff as well. And that's essentially preserved the tradability of the US Treasury. And that's very important in order to preserve the safe asset status for the US Treasury. So let me conclude. So the fiscal debt sustainability analysis, of course, there's idiosyncratic risk. The more idiosyncratic risk people have to bear, the more precautionary savings they want to do. That depresses R and potentially below G. Okay, and that allows then the government to run a Ponzi scheme. They can mine the bubble. Of course, the R might go up again, so we have to take this into account as well. But it gives some extra fiscal space. But there is a debt Laffer curve, and I mentioned that's the standard. What you really tax is that people try to self-insure themselves through dynamic trading strategies. But the safe asset might not be guaranteed. You might also lose the safe asset on your US Treasury if you do it too much. And it also depends what's the alternative safe assets there are. But a safe asset is like a good friend. It's individually good because it allows you to self-insure through retrading, but it's also good in aggregate because in times of crisis, it appreciates in value. There's this flight to safety. And that comes from this negative beta, comes from the fact that the crisis, idiosyncratic risk is going up. And that makes the service flow more valuable. And that's why the whole government bond gets a negative beta. So it's a standard asset pricing perspective, but with a service flow perspective, and I think that's very important. It's different from a convenience yield. To some extent, a corporate bond can also benefit from this if it's sufficiently safe, but the flight to safety is really the key which drives the whole thing. And then it raises the question, if you have competing safe assets, there's US Treasuries, there's a German Bund, when will you lose the safe asset status? When will it move over to the other one? And you better watch out if you go too dramatic. And finally, I would like to say something. I think it's very misleading to look only at the debt held by public hands. You really have to look at the consolidated balance sheet between the central bank and the Treasury, because essentially the Fed is just buying these treasuries and issuing reserves, and reserves are also very interest rate sensitive, with very short, with very high duration, essentially. With very interest rate sensitivity. So that's essentially, one should actually look at a consolidated balance sheet for the whole government, not just a part of the government. And that's, I think, what makes one more or less worried about whether one preserves the safe asset status. I'm not arguing that the US will lose its safe asset status because everybody's debt level is going up so much, but one has to watch out, essentially. Thanks for that.
Thank you very much, Marcus. That was really good. Then let's just do one quick question from Christian Mueller, who asked Marcus, is there any direct empirical evidence, beyond model simulations, that traders concern themselves with the bubble term as you described it here?
That traders are worried that the bubble might burst?
No, that I think what the question is asking is there any direct empirical evidence that these precautionary savings effects that you're documenting that's generating this bubble term really is something that actual traders are concerned with? Yeah,
it's not only traders. Everybody, so the empirical evidence, I would say, it's, for example, Stein's debt valuation puzzle. Why is it the case that there's so much extra value there? That would be one way to say, oh, that's empirical evidence. But in general, many people hold safe assets for precautionary savings reasons whenever they face a idiosyncratic shock. I think that's going. So what we do, we calibrate this model, of course, and get sensible numbers out. But it's very consistent with Stein's calibration and others' calibration as well.
So you would essentially say that the model also would apply, for example, to mutual funds, of which some may have outflows and some may have inflows, but they nonetheless value the debt.
So whoever has this idiosyncratic shocks, it might be institutional frictions as well, and they want to hedge their idiosyncratic risk in and outflows, and that's why they hold a lot of treasuries or other safe assets. And that's where the demand comes from, and that depresses essentially the interest rate you have to pay on these instruments because they give you this nice service flow. And we have to take this into account in our asset pricing models. And we have already previously taken into account this collateral constraint. Now, you worked on this, many others have worked on that, where treasuries give you a better collateral, they relax your collateral constraint. That's why it pays a low interest rate. But here, this retrading, I think, is equally important, or even quantitatively more important than purely a collateral constraint story.
And could we think about the foreign official holders use
That's the same thing, yes. So if you look at all the reserve holdings by foreign governments of holding US treasuries, they are all holding for precautionary savings. Say, oh, when we have a negative shock, idiosyncratic to our country, we want to be able to have extra reserves, and then we want to be able to sell it off. And that's in times of global crisis. Others want to buy the US Treasury. That's a good time to have the US Treasury because it has this negative beta. And that's all part of this demand. It's not part of our model. We don't have an international model but that's all coming from the same thing. It's all the service flow, which is granted, the safe asset service flow granted from the US Treasury. That's a huge privilege the US has, and certain countries have, like Japan, Germany, US. Within Europe, everybody is fighting to get to the same privilege. Because in times of crisis, you can issue new debt with a very low interest rate. That's a nice privilege. Ask the Brazilians whether they would like to have that.
Definitely. All right, thank you.
Can I just make one comment? So the debt held by the public includes the debt held by the Fed? Just to clarify, that was a question that came up and I think Marcus just raised too. So that includes debt held by the Fed.
So
It's
we
just not the
consider consolidated debt
intra-government, like
actually-
social security assets, that it's not included in there. Just to clarify, sorry.
Okay, thank you. Great. Let's move on to the last paper, the last panel presentation, and then we'll have some more Q&A after that. Ricardo, please go ahead.
Great, you can hear me and see the slides, just confirm.
Yes.
Okay, great. So I'm going to be presenting some very new work. It's 4 days old, I think, which is a non-technical survey of some of the work in this area, which includes the 3 papers that just were just presented. That really, or my goal is to try to answer some of the questions that Nelly raised using these 3 papers, as well as a broader set of another 10 papers or so that in the last 6 to 12 months have been written to think about it. So my starting point is debt is very high. 2 great papers written in 2017 and around the same time, although one took a little longer to publish, said, well, with R less than G, is this bad for welfare? Maybe not. Is it sustainable? Maybe, maybe not. It depends on some circumstances. I think this exciting new work that you saw from Amir, from Marcus, from Stein, has shown you that there's more that can be said about it. And I'm going to try to frame this in one common term. For sure, I'm going to not do justice to the richness of different papers and models, but from taking one perspective, I want to revisit debt sustainability from the perspective of how can it be that this debt is sustainable if in 1980 we were discussing is this debt sustainable and it was half of what it is now. So to do so, I want to start with some simple accounting that you've seen already, but it is important to re-express it, and I'll give a slight different spin that allows me to connect this different literature. The increase in public debt is equal to the return to the bondholders minus the primary balance. This is an accounting identity. And if you use a discount rate D, an arbitrary discount rate that has one important constraint, it must be that as time goes to infinity, asymptotically in some distant horizon, at some point, the expected value of this has to be bigger than the growth rate in the economy or the growth rate of the debt, if the debt is not to disappear. Then it is still just accounting to write that debt to GDP is equal to the expected present value of primary balance of GDP plus the expected present value of D minus R times debt to GDP. Okay, this is just accounting as far as just mathematics. This is in mathematical terms, this is a differential equation. This is the integral or temporal version of that differential equation for a particular discount rate. And for very different discount rates, you're going to end up with different values of this. Like Stein noted astutely just an hour ago, though, all economics comes in what D do you pick? That's where the economics comes in relative to the accounting. And the classic choice is to use R, the return on the debt, such that this becomes 0, and this expected present value is calculated using R minus G. And that was in many ways the equation that drove some of Nelly's analysis, okay? This is what has then been traditional debt sustainability, hundreds, if not thousands of papers written in fiscal councils, IMF, and others. Well, first, let us measure whether this equation holds. Let's measure debt, take into account, as was already just discussed, the fact that it's hard to combine different branches of the government. It is hard to net out assets from the debt because the government can always sell some assets when it runs into trouble, as well as whether do you include debt such as social security debt. And particularly important for countries, this is for countries that have gone through IMF programs, is contingent liabilities. The fact that there's lots of things that the government has insured, and especially after 2019-20, this is familiar also to people in advanced economies. The government provides lots of guarantees that often will then come and show up all of a sudden in a crisis. So measuring the left-hand side has been difficult, but there's been an enormous amount of work trying to do so. How does one measure then sustainability? Well, compare the left-hand side with the right-hand side. But how to measure the expected present value of primary balances? Well, Nelly showed you that, and here is a slightly older version of the CBO. She had a more recent CBO report. And the hard thing with that is right away that we need to forecast what's going to happen, as Nelly noted, with retirement and healthcare at very long horizons, and where with R minus Gs that are close to 0, whether they're positive or negative, let's not even let's not even talk about it. Just the fact that they're small means that even 40 years from now, 50 years from now, these numbers matter a lot. A more fundamental challenge is that if the US keeps on running deficits for a very long time with no expected surpluses, boy, you're going to end up with a negative number here instead of a positive here, something that's already also come up and which I will return to. A different approach to debt sustainability. So this is debt sustainability analysis that you saw in Nelly's presentation for a few slides. A different approach is to look at fiscal reaction functions, which is nothing but estimating whether the balance, the primary balance, rises when debt goes up, because if it does so, then this will automatically adjust to rises in this in order to ensure that the two are equal. It's sometimes known as the bond approach. It's Henning Bond really innovated in doing this in the late 1990s. And if you go and estimate this, all you need is that sigma's positive. Sigmas tend to be positive. And I really like this figure because it shows you whenever we've had a debt crisis, the US has tended to respond by running primary surpluses, although less so recently. And let's see if that happens recently. Insofar as here, it was a very moderate response. In other words, these sigmas have gone much lower since 1980. We no longer have the large debt increases come with surpluses following them. And that is part, I think, of a legitimate concern about sustainability today that was not the case in the 19th century or after the world wars. And a third approach has been to write economic models of Laffer curves and then look at the peaks of those Laffer curves, where the difficulty there is that taxes is just half of the story. The other half is spending. There's also curves for spending. They can be cut. And of course, this depends on models and extrapolations. This literature has not only measured that sustainability, it has also highlighted some very classic trade-offs. What are four of perhaps the most famous ones? The austerity wars or austerity debates. If you raise the primary balance, you may be lowering the growth of the economy, so the right-hand side may end up falling, in which case you've actually made things worse. The structural reforms debates. Yes, if you can raise the growth of the economy, that makes things better, but there's always a politician willing to sell you how if you just run a deficit in the short run, they will raise G and raise the right-hand side, and half of the times that doesn't come true. And then in the end, you end up with a lower right-hand side. The default literature, going back to the seminal work of Guillermo Calvo. Hey, default lowers the left-hand side, but it also leads to a default premium, an increase in R, and may therefore lower the right-hand side even more, in which case you end up with even potentially multiple equilibrium, and the ability to default makes your life worse. Hello, Latin America. Fourth, the inflation debates. Unexpected inflation is going to lower your left-hand side potentially, but expected inflation is neutral because it raises R and G equally, and the expectation that you may use inflation leads to a risk premium, which increases R and lowers the right-hand side. And therefore, inflation is not an obvious panacea. So this is, again, a survey of the traditional debt sustainability analysis, hundreds, thousands of papers, fiscal councils, and others. What is novel, or why is this literature, in my view, being appended, or at least being somewhat questioned, is that, remember, the only reason to start by focusing on this equation in the first term was if mathematically you could write it. And you could write it, if you recall, only if the discount rate is bigger than G, and you use R as the discount rate. And when R is no longer bigger than G, like Marcus showed, you get some plus and minus infinities that make this mathematically much less valid. So it's becoming hard to do sustainability analysis because all those limits, all those sums start exploding, no matter what trade-off you're trying to emphasize there. The argument that I think is common to this literature, and you already saw it in both Stein and Marcus, and I'll speak more about it, is that, well, but maybe we should be using something else to discount. We should not be using R. From a finance perspective, like Stein said, the market return is a value gas discount factor. It's the one that that's the inside of the CAPM. It prices all the different assets. We should be using some market return to be discounting it. Or in Marcus' perspective, but if we have incomplete markets, the market return, well, it's an individual return. And it's that market return adjusting for individual idiosyncratic risk. But either way, it's not the short-term, it's not the government debt safe interest rate R they should be using for discount. Is instead what I'm going to call an M. Marcus called this an R star star. Stein called it an R plus RP. I'm going to call it M because I think it's short for just market return. I also call it M because I like the duality of the fact that coming at it from a macro perspective, as opposed to a finance perspective, which assets, which risks, you just think of, look, what is the alternative to buying government debt? It's to buy the private capital stock. So Modigliani Miller, there's lots of different financing perspectives, but ultimately what you're buying is the capital stock, in which case what you should be discounting with is the marginal part of capital, which conveniently also starts with M, in which case, and finally, another argument to discount with use a D that's M, this is the dynamic efficiency condition in OLG economies. So if you go and discount with M, you have that now you have to take the present value with this M. But importantly, there's now a new term, a debt, I'm going to call this a debt revenue term, to try basically to unite a literature that is called it many different ways, as you've already seen in some of the presentations. In that case, where does this come from? Why is this not zero? Well, it comes, as you saw in Stein's presentation, because the private markets, the private capital stock is risky, unlike government debt, which leads to a positive gap between M and R arising from that risk. It can be instead a safety premium, as Marcus highlighted. Indeed, what happens is that the public debt may be a safe asset against the idiosyncratic risk of the different M's, driving a gap between M minus R. But other reasons in the literature, it's a collateral premium. You can use public debt potentially as a collateral, either voluntarily or coerced by the government, who says that you need to use it as a collateral or to hold it, in which case sometimes it's called a repression premium. It can be just that public debt is more liquid. You can sell it more easily at lower cost and other things, in which case this is a liquidity premium. Or it can be a bubble, which is more of a catch-all term. And so, for instance, Marcus used bubble and safety somewhat interchangeably in his presentation, but somewhat broader than that. More narrowly, by the way, this term should not be completely unfamiliar to macroeconomists. When we talked about currency, currency is not as an alternative to government debt in a world in which government debt pays M, the marginal part of capital, say Sidrowski's world, then M minus R, well, M is the interest rate on government bonds, minus R, the return on the currency is the inflation rate, minus inflation rate, M minus R is nothing but the nominal interest rate times the money stock. This is what's sometimes called seigniorage in the monetary literature. And finally, in the more recent literature on QE, this is the habitat premium, or the profit earned by arbitrageurs that trade across different forms of government bonds towards the safe asset. Either way, an extremely rich literature that goes far back that essentially argue that this term exists, that one should use an M, and that is different in terms of what you measure in terms of debt versus M, but including this term becomes a unifying framework in order to think about both the papers you've seen, as well as why they change the sustainability analysis, is that you have to start thinking about this new elephant in the room. But is it an elephant or is it a rat? Let's measure it. First of all, just the back of the envelope is very useful, I find. Well, I don't know, I find it useful. Maybe you'll not find it. How big can this be? Okay, let me measure R times debt divided by GDP. That's simply the red line here. The red line is just interest payments divided by GDP for the G7. What about the M times debt to GDP? Well, I know that GDP, so I need an M. Well, pretty much I picked up 4 textbooks that I have here, Acemoglu, Barrow-Saleh Martin, a bunch of them. And the standard textbook answer is, hey, Ramsey formula. The growth of the economy is equal to the temporal substitution times M minus rho. Plug in G and rho 2%. That's what these guys do, my textbooks. An interval substitution of 0.5, which if anything is on the high side, you end up with an M of 6%. And indeed, in all these textbooks, you always have M's of around 6%. Multiply 6% by debt GDP in the G7, and you get the green line. How big is this? On average, 4%, latest numbers, 6%. Multiply that then, if you want, take then the gap of the flow and divide by M minus G, i.e. 4%, and you end up with a present value of 95% of GDP, very easily just using the standard textbook parameters. That's a lot of money. It's 100% of GDP, especially when you compare with the blue line, the other term, the term that debt sustainability has spent all its effort on, this one, which is on balance negative or zero, and therefore very close to zero. Okay, so there's a lot of potential here. Now, how do we go about measuring it? One way to measure it is precisely to reinterpret, use Stein's work with co-authors and say, hey, I'm going to measure this as a residual. I'm going to measure this animal here subtract that GDP from it, that's my debt revenue term. Forecast future balances, use a measure of M that indeed captures the market. And what Stein showed you, you get numbers here that I picked 1 to 146. He mentioned 100% or 400%, depending on which period you look at, but somewhere between 100 and 400% of GDP if you want. Another paper has done this for Holland. You end up with 50-ish% of that. And here, really, I can go very fast because it's basically the insights that Stein told you. You can argue with the numbers, is it 50, is it 200, but it's very hard to argue with the argument that these things are negative and forecasted to be negative. So at best, you can say they were zero. But on top of it, because the balance are procyclical and they inherit the long-run risk of GDP, you're always going to end up with this being at best zero, most likely a negative number, which means that since the debt is high, the debt revenue must be very high. Okay, maybe puzzlingly so. And that's the puzzle that Stein was mentioning. Another way, though, which links to Marcus's presentation, is let me go and measure M minus R instead. Well, if you take my macro perspective, let me measure M as literally the marginal part of capital. We divide the capital share of income by the capital to output using the standard NIPA table. What's the marginal part of capital? It's 11%. Now, maybe you say, well, you want to take out corporate income taxes, or maybe you think that some proprietors' income is included in capital when it should be L. And maybe you want to take out rent payments because you think this is not really reproducible capital. But on the other hand, maybe you want to adjust for market power, which means that the marginal part of the capital payments are overstating or understating the marginal part of capital. Either way, you end up with this set of numbers. Or maybe instead you want to use some equity measures, narrower or broader. Or maybe you think the alternative is really housing, or maybe equity has paid too much, in which case you want to use expected stock returns. More narrowly, maybe you think, no, what I really want to measure is the measure in corporate bonds. And then really, really narrowly, you can talk, and like Marcus already said, say, well, no, I want to look at something that's really close to a government bond, like an interbank rate or a foreign bond. And this links to the work that, say, Annette has worked on. Here's instead the R's. If you look across, unless you take an extremely narrow view of what the alternative is, money measures, as opposed to what at least to me seems natural, which is take the M, the marginal part of capital, you end up with M minus R's that if you look at the one that I had before, 4%, they seem perfectly consistent with that. And more importantly, like Marcus noted, once you realize that these M minus R on average are not just large, but have a negative beta, you can have this not just be at least 10% of GDP, you can have the debt revenue being 150% GDP. In other words, the debt revenue is not only backing all of the debt, it's also backing Stein's puzzle that the expected present value of this is negative. Okay? So in principle, not only can this be big, actually, when we go and measure it, this may be all that matters, even if the debt sustainability, or in other words, the debt sustainability has been focusing on the irrelevant term. The relevant term is instead this one here. So that's the measurement. And hopefully that was useful also in the context of with the details of the past two papers. But what about the other thing, which is, remember, there was not just measurement, there were also trade-offs. So not only I'm telling Nelly, look, there's another term, and it's a very big one, and measuring it is important to assess what's sustainable. But on top of it, hey, zero? But I started 10 minutes ago. You sure? Okay. Well, I'll rush and talk for 3 minutes.
You can take a couple of minutes. I think you started around 11:25.
31. Okay. Oh, never mind. So sorry. Okay. So let me take 2 minutes. Sorry.
We have a little flexibility.
I think I miscounted something. So then let's talk about different trade-offs. Well, there's going to be a trade-off every time you talk about a model of what makes M minus R positive or what makes that special. For instance, if it's because it's a useful store of value, that is, it's an alternative private credit, you're going to have that financial development, social insurance, lower inequality may be good for welfare, but because they diminish the demand for public stores of value, they're going to shrink the net revenue term. At the same time, public investment more than pays for itself now, insofar as public investment is going to raise marginal parts of capital. If instead that it's the safety models of and let me focus especially on Marcus's one since he just presented, that makes the debt special, then you have, as in his paper, although he didn't present this part of it, that inflation risk as well as fiscal reaction functions are going to have a very big impact on this debt revenue term. In particular, price stability is crucial to maximize fiscal capacity because it keeps the safety of the public debt. And it's important to think about fiscal reaction functions in keeping that debt safe. If instead it is collateral, taking the collateral perspective, we have that after 2020, we should actually be doing less tax smoothing than in the classic Barrow analysis, and we should be paying the debt very fast. Why? Because that is the way to preserve the debt revenue term. At the same time, in a recession, if the shock we think raised or lower demand for collateral, we may end up with much higher or lower multipliers. And determining what happened to the collateral value of the debt in 2021 becomes the very important feature of what the multiplier will be. If that provides liquidity, then a different trade-off is that, well, the Laffer curve that Mark has already partly emphasized, but also that as more debt lowers debt revenues, it may raise long-run risk in the economy. And in doing so, lowers investment. If instead, and this, I'll be very fast in Amir's paper since he covered it, if we have instead that there's a currency that comes with an effective lower bound, then more debt, because it does not affect the interest rate, has a big impact on net revenue and more than pays for itself. But as well, a couple of other trade-offs, which is with sticky prices, it turns out that QE, or changing public debt for money, is going to have a big fiscal footprint because raising currency comes with inflation and output, while the public debt does not. And we're going to have that with a trade-off with bonds. What about welfare? Well, when it comes to welfare, there's a powerful Friedman argument to drive the debt revenue term to zero. There's a counter argument, which is basically all the trade-offs I said, which is in a second best world, we would like to offset the need for the social taxes. It is important to note that none of these theories break Ricardian equivalence in the following sense. The Barrow argument, which he's restated in a recent paper, is if I give transfer to a household, finance by selling bonds, and pay bonds with lower taxes on the same household, the household understands that the low return on the bonds also means less tax on the future, and this is neutral. Of course, what breaks Ricardian equivalence is if different households are involved. And finally, a bunch of also papers in the last few months, is debt more debt Pareto optimal? Yes, said Olivier. But more recent papers, if you take into account of the less than M, it actually depends, because it will only do so if you can either subsidize M, or if you would, or it is inferior to providing public insurance, and with market power has a countervailing effect that makes it worse. To conclude, classic debt stability literature focuses on the present value of surpluses, and this is the work that is being done as we think about how to pay for the pandemic debt, how to write new Maastricht rules, or whether we're going to have a new sovereign debt crisis. A very active literature, which I try to summarize, and which was very well represented in this panel, has said that actually classic debt stability analysis is missing a very big term. That term means that there's a lot more fiscal space out there than may have been appreciated before, although its size is really about M minus R, which, by the way, again, Atif mentioned is R minus G plus phi, Mark is the R double star, but they're all, if you want, I'm using M as a catch-all name for, in a sense, very many of them. Measuring it, it may be very large, but still an enormous amount of uncertainty. You saw the debate between Stein and Marcus. And in modeling it, we end up with very different principles coming from fiscal management, as well as new rich trade-offs that in some ways I think are really enriching in very different ways how to think about that sustainability. Thank you. Sorry, Annette, I must have mistimed something.
It's okay, no worries. Thanks a lot for the great survey. So I want to just kind of try to summarize some of the questions that have been asked, and then I'll give you guys a chance to react to each other's presentations. So one theme that comes up in the questions is the effect of more debt on G. I guess I would address this question to Nelly in the sense of thinking about, for example, the Build Back Better. Do you think of this as something that through these infrastructure investments, for example, will have an effect on the long run G? And what are you guys' thoughts on the link between debt and G more broadly?
Want me to take that now? There's infrastructure bill and there's Build Back Better. And I think there's pretty common agreement that the infrastructure bill is pretty critical to increasing G, if not just maintaining G. So there might be some low. Build Back Better has other elements to it. There's climate change, which may or may not increase G, one can imagine, but there's also some more social programs in it. So it is not designed specifically to increase G, although there are some elements. So I don't want to, there's a lot of things proposed in it, and what will end up in the final package is hard to know. But I think part of the thinking of the Build Back Better incorporates the idea that R minus G has been negative again, is forecast to be negative for a while, and there may be some fiscal space. So I would sort of characterize Build Back Better as not strictly to increase G, but that it affords some fiscal space for some other fiscal objectives. That's, again, I'm speaking my views, but I think that's the way I would think about it. What I tried to say in the presentation, though, is it's not that R minus G or some other terms suggest that there aren't limits to fiscal spending. And there's some risk assessments around that kind of discussion that need to be considered, including being prepared for the next shock. And even if everyone runs to treasuries, there still could be some, it could depend on what the shock is. But so I think the answer to G is, of course, some of the infrastructure is designed for that, but not all the fiscal spending is designed exactly for that purpose.
Thank you for that answer. Another theme that's come up is the issue of, is it possible that markets are just getting this wrong? Which I think is a bit where Stein came out in his thinking. One of the questions also refers specifically to the lack of downgrades, and we haven't had a lot of credit rating downgrades as governments have increased debt a lot. Stein, I don't know if you want to take the question in terms of, is it, do you view your puzzle as resolved with the comments that Marcus made, or is it possible that markets are just getting it wrong?
This is a great question. I mean, first of all, I want to say that I think there's a lot of plausibility to the idiosyncratic risk channel and the precautionary savings channel. I think what it does in incomplete markets in general is, raises the real rate. Now, in general, unless you have countercyclical idiosyncratic risk, that channel will affect all expected returns on all assets, right? And so I think the key empirical question is here: what is the effect on the GDP risk premium, right? So if this precautionary savings channel, does it just lower all expected? Does it just change all expected returns in parallel, or does it affect expected, the risk premium, the difference on expected returns on, let's say, a claim to GDP or the stock market and the risk-free rate? And I want to think of that in terms of like a narrow versus a broad measure of convenience yield, right? So in your work on it, you've been thinking it's potentially all the, I think, how powerful a resolution his idiosyncratic risk explanation is, I think ultimately depends on what is the effect on the risk premium, on the aggregate risk premium in that world. So that's kind of where I come out. I think this is an unresolved question, and I think it's certainly very open to his explanation, to his resolution.
A third theme that comes up in some of the question is the role of the Federal Reserve. Given the importance of government debt somehow being special, it seems like there's a lot of value to making sure that it remains special even in crisis. In terms of Marcus's work, he's arguing that the government debt has negative beta. That's what it usually has, but then in the middle of March in 2020, suddenly it started to have high positive beta. What do you guys thought in terms of how far the Fed should go to sort of protect the special status of treasuries, and are there any alternatives you see in terms of maintaining that status? And this is addressed to any of you guys who has thoughts on this.
Let me take just one stand on it, which I just wanted to completely back up something Marcus said. And I think that maybe I'll turn it over to Marcus to think more deeply. But I think one of the biggest puzzles that we have is how we should think of Fed purchases of treasuries when they're just being financed by the household sector ultimately, through deposit issuance to households. And I think that Marcus is exactly right. I've seen a lot of people argue, oh, somehow we should take out the Fed purchases when we're thinking about how much debt is being held by the public. Nelly obviously is not doing that, but I'm saying I've heard other people say that. Obviously, there's an effect on the term premium, but let's just get rid of that and just think about government debt in general. I mean, reserves are a government obligation. And so I've just been very puzzled at arguments, really strong arguments, that the Fed is driving pricing in a dramatic way. Again, the term premium I understand, but just generally, it's something that I'm a little puzzled by. And I think there's more thought that we need behind that idea.
If I may chime in. So
Yeah,
I
please do.
agree. I think the Fed plays a very important role to maintain the safe asset status of the US Treasury. I think that was the right decision in March 2020 to maintain the market liquidity of the US Treasury. And this way people can retrade and go in and out and all the different deposit facilities. I think that's a very, very important role for the Fed to play. So there's one component, what Amar mentioned, is how much debt is outstanding in general. And of course, a lot of debt now is outstanding through the Fed buying it and the Fed then issuing reserves, and then the banks have to hold that. And that's then essentially you have to add to the held by the public, not only government debt, but also all the reserves issued by the Fed. And the other issue is that the Fed has to play an important role to preserve the safe asset status of the US Treasury. And for that, it's very important that market making works very well. And of course, there's some structural changes underway to improve that. That's very, very important. But if they break down, then you have somebody, a market maker of last resort, to step in to make really sure and guarantee that at least the smooth trading is working. That's only one component to preserve a safe asset status. There are other components as well, but that's one important component to handle.
So if I can come in very quickly on the first point, let's not forget that what happened in the idea that the Fed can always backstop the bonds has already been clear, but I really want to emphasize that. The Fed is borrowing as well from the banks. And the reason why this worked in 2020 was we sent big checks to people and they went and deposit, and they were locked at home and deposited the banks. So what we really had was the Fed being an intermediary in the government transferring you money and then borrowing from you, almost like a Ricardo equivalence type exercise. And that's what kept it sustainable in 2020-21. As much as what the Fed did, the Fed was an intermediary to ease market making the Treasury market. But the macro fundamental is that people saved a lot, just as the government was borrowing a lot. And the government was right to borrow precisely because that increase in savings, as we've learned from Keynes 100 years ago, could have triggered a big depression. Those were the macro fundamentals, and the Fed was in between oiling the cogs, not creating a demand for public debt that didn't exist there.
But given that this is a finance audience, Ricardo, I just want to emphasize that therefore the study of how banks and deposits going to banks is crucial in the study of fiscal sustainability, right? Because that is ultimately what's going on in these crises.
Exactly. Right. That's how the information happened. And then the second point, sorry, just very briefly, is we also have to be a little careful in that if we're saying, well, but the way the Fed keeps the specialness of the debt, it's not just the Fed is always buying it beyond smoothing the cogs, because of course that comes with inflation. And that was a point that I tried to make in our presentation. Then the Fed will be creating the inflation risk, and not to mention, of course, exchange rate risk that makes the public debt less safe and therefore hurts the demand for it. So again, very careful with thinking about the Fed, either in the short run or in the second point, in the long run, as being able to actually have a materially sustained effect on the demand for public debt. Sorry.
Just add one sentence to that in a second, which is that I completely agree with everything Ricardo said. I think in addition, it depends a lot on what happens, right? I think Amir also made this point in his presentation. At the ZLB, QE could potentially be stimulating aggregate demand. If there's an aggregate shortfall, that could potentially be very valuable. If that same QE policy done in normal times could actually barely move the needle in terms of aggregate demand, potentially create inflation, like Ricardo just said. So I think a lot of it is state contingent.
I'll just add one more, and just let me add an institutional fact. It's something that I didn't quite appreciate before I joined Treasury. But being an observer of what happened in March 2020, Treasury markets did run into some dysfunction. Obviously, March 2020, the Fed did intervene as sort of a market maker of last resort. The Treasury bill market which the Treasury the Fed did not intervene in, really performed well. As you saw, there was like 2.5 trillion of issuance, and there wasn't any sort of dislocation. So, I mean, there's obviously a fair amount of work going on Treasury market reform, which, I could spend a lot of time, because that is an area I'm spending quite a bit of time on, but it is about market making in the coupons. But there is this distinction that sort of I tried to mention a little bit with Treasury debt maturity issuance, bills and coupons, something I hadn't quite appreciated till I joined Treasury. So just to include in that, when people are writing down models and thinking about this, that might be useful.
Yeah, exactly. That also raises the issue whether the Treasury should be more proactive in managing the maturity structure in order to preserve the special status of the debt, as opposed to the Fed stepping in. So there's some interesting institutional issues.
Absolutely.
All right, we're out of time. So I just wanted to just say thank you, everyone, for, I think, a really productive session. I think that everyone's comments tied together really well. I hope that you guys in the audience enjoyed it. And the session will be posted so that you can have your friends and students and so forth watch it many times going forward. Thanks a lot, everyone.
Thank you.
Thanks, Annette.
Thank you so much, Annette.
Thank you, Annette. Thanks all.